Hi all, good evening. Welcome back to another session of our MVP webinar. And today's topic we will be talking about a risk reward ratio, one of the most important topic when it comes to stocks trading, okay? Even if it's a stock or even if it is options, I'm very sure some of you have never heard about risk reward ratio as an option seller. So today we're going to look into a very different perspective on how to look at the risk reward ratio when it comes to being an option seller as well as being a buying stocks at outright. Also, we're going to look at the another element of the MVP screener. We have looked at the bullish volume anomaly, and we have also looked at the bullish 3 black crow. So today we're going to look at the third element, which is related to the value anomaly strategy, which is buyers at support. Okay. So we're going to get right into the risk reward ratio. So first of all, what is risk reward ratio? It is extremely important to manage your risk, as those who manage their risk well will be able to stay profitable from year to year. So the whole idea of risk reward ratio is each time when we are going to invest, we're going to buy a particular stock, we are definitely taking certain amount of risk. All right. So when you take certain amount of risk, how well should you be rewarded? That's how we actually look at risk reward ratio. So if you are taking a particular amount of risk, how well should you be rewarded? That's the idea. So if the reward is not attractive enough compared to the risk that you are taking, then we should not trade. That's the idea behind why risk reward ratio is extremely important in order to be a successful long-term investor. What I mean by long term is to be profitable from year to year as you go on. Okay. Risk reward ratio is measured by your target profit divided by the maximum loss. We're going to look at each of these elements separately shortly, but this is the whole formula. What is your possible profit out of the trades that you're going to take, and what is the possible loss that you may face when you take that trade? So dividing both of them, that will give you the risk reward ratio. So we have three strategies, all right, in MVP. First is the value anomaly strategy, and we have the value breakout, and we have the value riding. For both the value anomaly and the value riding strategy, our target profit is definitely the sell region of the value channel. Okay. So the sell region of the value channel is the target profit. But in value breakout, you don't really have a sell region yet, because when it breaks out above the sell region. That's when we define it as a value breakout. So what will be our target profit for such case? So target profit for a sideways channel or static value channel, all right, is the size of the sideways channel or side of the static value channel, you plus with the resistance turn support price. Okay, so that will give you the target profit for value breakout strategy. For example, for me to explain this better for the value breakout strategy, imagine this is our sideways static channel. Okay, the price is moving like this. Okay, upon it breakout, our target profit will be to calculate this magnitude of the sideways static channel, then take this magnitude, extrapolate from the resistance level, and then you get your target profit. So this is your target profit for a value breakout strategy. It doesn't mean that the price wouldn't go higher than this level. What I'm saying is that we will set that as the benchmark for our first target profit. So to explain it better, this is the two channels that we always have. For shifting value channel, obviously it is for our value anomaly strategy and as well as the value riding strategy. So we have our wave going up and going down. So how do we know when is the sell region? So what will be our target profit? So let's assume we are here, we are about to take a trade at this particular point. So what will be our target profit? How do we actually calculate it? Okay, so what we do is we calculate this magnitude. Okay, what is the previous down move, this whole magnitude. Okay, calculate the price, total price movement, and then we extrapolate it from this location. So that will give you the target price. Okay, so this is how we do it for shifting value channel. So when we switch to the static value channel, okay, we have this particular wave, static value channel. So in order to get the target profit upon a breakout is to calculate this particular magnitude, okay, of the whole sideways static channel. Then we extrapolate it from the resistance level and we add up. Okay, we add it up. So this will give us the target price. Okay, so I hope that's clear on how we actually calculate the target price for shifting value channel and as well as the static value channel. So moving on. So in risk reward ratio, if you remember that I have actually mentioned to you all earlier on, whenever we want to set a cut loss, all right, whenever we want to set a cut loss, I always say loss is based on a preset cut loss level, which is usually, some of you probably in the workbook I would have mentioned 3% to 4%, but 2% to 4% is still acceptable. Okay, so 2% to 4% from lowest price of support level. Okay, so there's always been question. Okay, so 2% to 4%, how do I know should I use 2, 3 or 4? And as well as, can I not use the lowest price of support level? Maybe I just use the previous highest point of the support level, or etc, etc. How do we decide all these elements? How much 2% or 3 or 4? What is the right price to choose as the support level to calculate our cut loss level? So this is where you have to know risk reward ratio. You adjust this value based on the risk reward ratio, which I'm going to explain to you all shortly with a clear example. Okay, so let's move on. So remember, maximum loss is obviously based on the preset cut loss level. So we already know our target profit, which is needed to calculate the risk reward, and our max loss is based on our preset cut loss level, 2% to 4% from lowest price of support level. At minimum, a risk reward ratio should be 2 to 1, although the preferred ratio is 3 to 1. Okay, so when you divide, your reward by the risk, your reward should always be more than the risk. At least the reward should be twice more than the risk you are taking. Okay, why is that so? Why do we want at least twice? Okay, and the best is of course 3 to 1. That is for value anomaly and value breakout. Value riding strategy, as you all are aware, that is based on a rebound from a moving average as the stock price is moving higher. During such scenario, there is a high possibility that the channel is probably more narrower, slightly smaller. So in that case, it's sometimes acceptable to take a 1.5 to 1 risk reward ratio only for value riding strategy. Anything else, any other strategy, you should keep to minimum of 2 to 1, or the best will always be 3 to 1. Okay, so I hope that's getting clearer right now. So remember the differences. So value riding and value anomaly, okay, how you calculate the target profit. And also remember, in value riding, you can have a smaller risk reward ratio. So why the reward should always be more than the risk? That is basically a logic, all right? Whenever we do anything, any risk that we are taking, we always take a risk, a calculated risk, provided the reward is much higher than the risk that we are taking. It's the same in the stocks in stock investment. The main reason behind why reward should always be more than the risk is that any losses can be recovered quickly in the next coming trades. That is one of the reasons why we always want the reward to be higher. And at the same time, when your risk reward ratio is at least 2-1, that basically means there is a higher chance for the stock to move higher than to move lower. That's what basically another way to see it. When the risk reward ratio is 2-1 or 3-1, it shows that the stock has a much higher possibility to move higher than move lower. Okay, so remember, this risk reward ratio helps to keep our account profitable in the long run. That's the whole idea. Never take trades that has a risk higher than the reward. It is just not acceptable. Okay, because if you continuously take trades that has a higher risk than the reward, you are basically just in a time bomb kind of scenario, because as soon as it explodes, your risk, the loss is going to be much bigger, that it will eat up all your previous trades profits. We don't want that to happen. If that happens, it's very difficult for you to remain profitable in the long run. Okay, so let's move on. So we have now seen the definition of risk reward ratio. So I'm going to show you in a real example based on what's happening right now. Okay, for example, using value anomaly strategy, I'm going to use Coca-Cola as the example. Okay, so here we have set the target profit of $50 for Coca-Cola. So I'm going to show you how I actually came out with a target profit of $50, and you're going to calculate the risk reward ratio together. Okay, so this is a stock of Coca-Cola. I've drawn the value channel and such. So I'm going to give you an example on how we are going to trade this. Okay, so let's just look at the calculation. So I'm going to go into the chart. Okay, I'm going to use the KO chart over here. So as initially when I was creating these slides, okay, the stock was roughly at this particular price level. Okay, let me just show it to y'all. Let me move it to a weekly, which is much more clearer. Okay, so we had a doji, hammer here. Then if you could see this is roughly kind of a pivot momentum pattern. So let's just assume we are at this particular point where the stock is actually at $42.50. Okay, we are here. Okay, $42.50. So we are right now here. We have our hammer doji with volume, and then we have our confirmation. So we're going to buy the stock at $42.50, assuming. Okay, so going back to our slides, so we are here buying Coca-Cola at $42.50. Then after, our cut loss level. How do we calculate our cut loss level? Okay, so going back to this, okay, you could see that this is where basically each time the stock actually rebounds. Am I right? Each time when it comes to this level, it rebounds. So where is actually our support level? So if you look closely, this is the price that each time that it rebounds. Okay, so this is the lowest price of the support. So roughly here is where it keeps coming down, rebound, comes up and rebound. So the lowest price is roughly at around $41.52 or 53 cents. Okay, so that is our lowest price level. So if we were to calculate cut loss level, remember we have a range of 2% to 4% from the lowest price of the support. So in this case, Coca-Cola, okay, we had our lowest price around $41.52 or 53. So in this case, I have taken $41.53 and I have set a cut loss level of 4%. So our cut loss price will be 0.964% times with $41.53. That will give us a cut loss price level of $39.84. Okay. So now we know our cut loss price level. We are going to buy this Coca-Cola at $42.50 and our target profit is $50. So how did I come up with this target profit of $50? So this is the way I'm going to show you, which I taught y'all earlier. What was the recent previous run up? Okay, previous run up, the price came down here and then it came from down here to up here. Am I right? So remember, for value anomaly, okay, for value anomaly chart strategy, our target profit is this sell region. If the price to rebound from here, the sell region will be our target profit. So this is how I actually calculate my possible target profit. So I calculate what was the previous price move. Okay, previous price move. I draw this particular arrow from the lowest point to the highest point over here. And what you can do in the TD Ameritrade platform is you can double click it and you show label and put it always. So you get this particular reading which shows this. So it shows that how many percentages went up and what is the price move. So over here, it went up by almost $8, $8.30 from the price from the bottom to up all the way up. So the previous price move was $8. So here I'm going to use the same projection to project over here as well. So from my buying from here, this particular level, which is around $41.50 or such, I'm going to add up another $8 to calculate my target profit. So what I did is I'm just going to take a rough amount, about $42. I just want a round number to make things easier. So I just took a $42, add up with the previous magnitude movement. Okay, so which was $8, so 42 plus 8, that's how I ended up with $50. Okay, so 42 plus $50. 42 is the price level from here, from the buy region, plus $8. That will give me the possible target profit for this value anomaly strategy using this Coca-Cola stock. So $50, there you have it. So what is my maximum loss? If I were to buy it at $42.50 and if I were to sell it at $39.84, that will give me a maximum loss of RM2.66. Okay. And my possible profit, if I were to buy at $42.50 and I sell it at $50, okay, which is my target profit, then my possible profit will be $7.50. So my risk reward ratio is possible profit target, which is the $7.50, and then my maximum loss, which is $2.66. That gives me around a ratio of $2.82 to 1. So this is definitely very close to 3 to 1 of the ratio that I usually want. Okay, of course minimum is 2 to 1, but I always love to have at least 3 to 1. So this is almost close to 3 to 1. Okay, and in case you're really not happy with this 2.82 and you still want a 3 to 1, a better way to restructure this is simple. Keep everything same, but just change your cut loss level from 0.96 instead of 4% loss, set it to 3% loss or 2% loss. In that case, you may get a much higher risk reward ratio. Okay, so if you set this to 0.97, probably you get here around $40 or such. So your max loss will be much smaller. So your risk reward ratio will be much higher. I'm very sure you'll get about 3 to 1 at least. Okay, so this is how you play with the cut loss level. Okay, so that you will be able to get the risk reward ratio that you want to. Okay, so you know the risk that I'm taking is predefined and I'm well rewarded for the risk I am taking. Okay, so this is how you calculate one by one. Now, moving forward, I hope this is clear on value anomaly strategy, how we actually measure target profit, how do you know the cut loss level, and how do you adjust it. I'm going to show another example later on how to adjust this cut loss level. So now I'm going to go into a value riding strategy. I'm going to use our recent example of oil ETF, which is USO. And here we have a target profit of $16.27. So how did I come up with this target profit? And let's look at the risk reward ratio for USO. So this is a chart of USO, what is happening right now and such. So let's just see how we are going to calculate the risk reward ratio of this USO stock and if it's worth it to actually buy it or not. Remember, all those risk reward ratio that I have been sharing with you all until now, it's all about from the perspective of buying a stock, not about options or such. It's all from the perspective of buying stocks. So let's calculate again the same steps. So you're going to buy USO at $13.40. So I'm going to switch my charts to USO. I've already drawn the so remember, this is a value riding strategy. So you still have all those channel, but slightly narrower. Remember, value riding strategy always have a much narrower channel. Okay, so we are here right now. So let's just assume we are going to buy it at $13.40. Okay, we are here. And if we look at the daily chart, it becomes a bit more clearer to see the channel. Okay, so let's just assume we buy it at $13.40. Okay, we are here. Okay, so we had a hammer over here and then we had a confirmation over here for an example. Okay, so if we were going to buy it at $13.40, okay, this is the calculation, then our cut loss level, okay, again we look at the lowest price of this particular down move. We are at support. Okay, we are at the support level, and what is the lowest price is actually at $13 over here, $13. So that will be our lowest price at the support, and we times with a 4% of cut loss, that gives us a $12.48 as our cut loss price level. Okay, then after, our target profit is $16.27. How do I come up with such value? It's the same as how we did it for the value anomaly strategy. Okay, so if I were to show it on a daily chart, it becomes a bit more clearer. So this was the previous down move from here and then all the way up over here. So if I were to draw the line again to from just say from here all the way to top over here, okay, and then of course do what I've mentioned earlier to get the total magnitude of move, you show label always, put it okay, and here you have the whole projection which says the total magnitude move previously from the buy region up to the sell region was $3. Okay, so assuming the previous move which we have calculated is $3, we are going to project the same thing over here as well. So if we project from this current price around $13, you plus with $3, okay, so that is how you ended up with $16.27. Okay, roughly you are here. Okay, roughly this region. You can take any price. You want to take 13, you want to take 13.20 or something like that, is totally fine as long as it is within this particular candles which are kind of crowded. You just take any of this price level over here. Don't be too particular about it. So in this case, I have taken $13.27 and I have, okay, $13.27, $20 something, and I added up with $3. So I got a target profit of $16.27. Okay, so now we have our buying price $13.40, cut loss level $12.48, target profit $16.27. Other things remains the same. So maximum loss is our buy price minus with the maximum loss that we might face, which gives us a maximum loss of 92 cents. Possible profit of $2.87. Okay, again, possible profit is obviously buy price minus with target profit. And we have our risk reward ratio, which is possible profit target divided by maximum loss, 2.87 to 0.92. That gives a very nice 3.1 to 1 risk reward ratio. Okay, so this is how you actually calculate it. The whole idea of the whole key is to be able to get your target profit and to calculate the correct cut loss level that will give you the risk reward ratio that we want to. Again, if this did not give us a 3, we could have just easily adjusted our cut loss level to probably 0.97 or 98. Don't go anything lower than 2%. Then you may get cut loss very easily. Okay, don't do that. I'm always comfortable with 3% at most of the time. Okay, sometimes if I have extra confidence, then I may have set the cut loss level slightly bigger. Okay, so now we have looked at value anomaly, we have looked at value riding. The method kind of remains the same for both of this. Okay, for the way we measure the target profit. So now the last one we're going to go is the value breakout strategy. We're going to use COP, ConocoPhillips. This is one of the stocks that were highlighted in the forum. We have actually this stock has after I posted this, it has actually went up by almost 30% if I'm not wrong. So I'm going to look at how we actually calculate the risk reward ratio for COP, which is based on value breakout strategy, and our target profit is actually 67. If I'm not wrong, that's where COP is roughly right now. So let's take a look on how we actually look at this. So this is how we have a COP. We have a sideways channel. We had this, and this. Okay. So then we had the price moving at the upper region. That's how I knew that this stock has a very high chance to actually move higher. And of course, we also had a Kiss of Life over here. A very nice, well-tested Kiss of Life. Okay. So how are we going to measure the risk reward ratio for such breakout strategy? So this is how we calculate it. So moving on, let's just assume we buy COP at $57. Why we buy COP at $57? I'm going to show it over here. So let's just look it from the weekly. So you have all this sideways, or even if you look at it from the daily, you have all this sideways moving channel. Okay. Then after, I'm going to use a weekly for this. You had over here as example of a double white soldier. Okay. So if it's a double white soldier, your price level that you probably will buy it is actually at $57. So this is where price broke out. Okay. Price broke out, came back to test the resistance, turn support, and then started bouncing back. If you did not buy it over here, you could have also buy it when you had a doji over here, then you had a confirmation over here as well. Okay, so $57, so that's the price target. Sorry, that is the price level we're going to buy, like assuming. Then the cut loss level is, I'm going to take a 4% over here out of $53. So over here, where did I get the $53 from? So it's no more taking these points over here, all right? So it has to be this particular resistance level that is possibly have turned into a support. So this is the price level that we take to measure our cut loss level. Anytime the price breaks 2 to 4% below this resistance turn support, then we want to exit this particular trade. So this is $53. So if you were to calculate a 4% cut loss level from $53, our cut loss level will be roughly at $50.88. Okay. And our target profit will be $67. How do we come out with that? So as I have mentioned, we project it based on what I have explained to you all earlier. we calculate the whole size of this static value channel. Okay, we calculate it. Okay, and then what we do is, once you have calculated this total magnitude of movement, we take this and we move it higher. Okay, we extrapolate from the resistance turn support and we stop there. So that will give us our target profit for this value breakout to be roughly at $67. Okay, so that's where the price is also actually kind of a crowding right now. So $67 is the target profit based on an extrapolation from the size of this static value channel. So that gives us $67. So that's how we calculate the target profit. So that after remains the same. Maximum loss is buy price minus the cut loss. Move on. Possible profit $10. And then we calculate our risk reward ratio. So here, if you realize, the risk reward ratio doesn't meet our criteria of a minimum 2-to-1. So this is not a right trade to take if we were to calculate based on this cut loss level. Okay, so this is where we actually do what? We adjust the cut loss level. We move the cut loss level to slightly smaller level. Instead of a 4% cut loss level, why not we switch it to much smaller? So this is a next try. Okay, so that earlier calculation did not give the value that we want, so we modify the values to see if it is able to give the risk reward ratio that we want. So in this case, instead of taking a 4%, we calculate based on 2% cut loss level. So calculating 2% cut loss level out of the $53 will give us a cut loss price level of $51.94. Target profit remains the same. So here, maximum loss, we have reduced it to $5. Earlier, our maximum loss was $6.12. So now our maximum loss is $5. Possible profit is $10. So our risk reward ratio is right now 2-to-1. Now we have the minimum risk reward ratio that we want to. Okay, so that's the whole idea of adjusting the cut loss level in order to get the risk reward ratio that we want to achieve. Because remember, we always want to get rewarded much higher than the risk we are taking. Of course, another level is also, instead of adjusting the cut loss level percentage 2% to 4%, you also adjust the price level over here. That is also another way. But my preferred way is, of course, to set the 2% modify based on the cut loss level. Okay, the percentage. So here you go. You have already seen a simple way on how you look at the risk reward ratio. Calculate it. We are done. So this is about buying stocks. Okay, guys. So remember, stocks, value anomaly, and value breakout. You want a minimum ratio of 2-to-1. Good one is, of course, 3-to-1. Then after, value riding, we want at least 2-to-1 as well. But 1.5 to 1 is still fine, because sometimes value riding strategy has a very small channel. So that is about buying stocks. I'm going to go about option sellers. Okay, this is a topic not talked by many people, because the way most people try to calculate risk reward ratio for option sellers, you actually end up with a very skewed risk reward ratio. You always end up with the risk is much bigger than the reward if you calculate usually the usual way. So here, when I trade, this is my own method. I actually don't look at the max loss. I don't look at the amount of credit we collect. I just keep to the simple support level, current price level, and what is our control price. So this is where the control price comes in. So we're going to look at this. But if you're going to do a quick decision, quick judgment whether you should sell an option on a stock or not, based on this MVP method, I'll give you a simple way is, do not sell options when price is at or above control price. That's it, done. Okay, always remember, if you see the price at control price or above it, just don't bother selling any options on that stock. Full stop. Okay, done. No more discussions, no more trying to adjust the control price in order to get into the trade. Just not worth it. Just go on, move on, look at other stocks. So how do you go actually to be a more calculate a more accurate risk reward ratio, okay, for an option seller? So this is how I do it, and this is how I encourage all of y'all to do it as well. So the three elements that I look at is support price, current price, and the control price. Obviously, I hope you all remember, in any value channel, the control price is the green color bar. Okay, so the two elements that you need to calculate is support price distance and price control distance. So this is the support price distance and this is the price control distance. This I will call it as SP, this I call it as PC. Okay, so what is the distance between the support to current price? What is the distance between the current price to the control price? So that's what basically these two elements means. So in an MVP risk reward ratio for option sellers, the price control distance, the PC to SP, okay, the PC to SP should be more or equals to 2 to 1. Again, it goes back to the simple concept that reward should always be higher than the risk. It's best to avoid trades with lower than risk reward ratio. Avoid trades with lower risk reward ratio than 2 to 1. 1.5 to 1 is still fine if it is based on value riding strategy. So again, value riding strategy usually has a smaller risk reward ratio. Okay, so we're going to look into a quick example. How do you actually use this? So remember, the two elements you need is a support price distance between the support level to the control price. That's the first, which call it SP, and the second element is the distance from the current price to the control price, which we're going to call it as PC. So over here, if you look at the R, okay, this is a rider system. I'm going to take an example. This was actually highlighted by the MVP screener, buyers at support screening method. So if I were to take this, okay, support price at $67, if you can see over here, each time the price comes to the $67.50, the price actually rebounds. Okay, the price rebounds here, okay. So the support price is $67.50. Then the current price, okay, the current price when I looked at this particular stock over here is at $71. Okay, you had a hammer here and then you had a confirmation over here. So this basically gives that the current price is 71, support price is over here, $67.50. So control price is actually $79. If you could see over here, if you project all the way up here, it's either 79 to 80. I just took a smaller value, so that will be $79. So you actually get a SP distance, which is the support, okay, as support to the current price, that is the SP. So you get a $3.50, $71 minus with $67.50. So you get the $3.50. You calculate the PC distance, which is the current price to the control price. That's the PC. You get an $8 distance. So finally, to calculate the option seller's risk reward ratio, you calculate this PC distance to SP distance. You get a ratio of 2.28 to 1. Okay, so this clearly gives us the minimum risk reward ratio of 2 to 1. So the chance of the stock moving higher is much better than for the stock to move lower. Okay, so this is how I actually calculate it. I don't really look at all those other options related elements, because end of the day, remember, option prices and everything that related to options moves based on what happens to the mother stock. Okay, so for me, I'm much more comfortable to look at how the price moves, how the mother stock's price move compared to anything else. Okay, so this is another example. This is taking Procter and Gamble. Okay, so Procter and Gamble, you can see over here, each time the stock actually moves, okay, moves lower than $72.50, it rebounds. So that is why you have a lot of hammers over here. Okay, it tries to break below $72.50, it goes back higher, it breaks below, goes back higher. So that is why I selected support price at $72.50. Okay, and then of course the current price is at over here, $74.22. Okay, remember we had a hammer over here and then we had a confirmation over here. That is why I selected the $74.22 as the current price. Okay, then control price is obviously $82.67, which is over here. So you have all those three elements you need. So now you just go ahead and calculate the SP distance, $1.72. Okay, the support price to current price distance. Then you have the price to current price to control price distance, same $8.45, and you calculate the risk reward ratio, you get an almost 5-to-1. Okay, even if the current price is slightly higher, you will still be able to achieve the risk reward ratio that you want to. So this is how you actually calculate it, a simple straightforward format using the stocks, using the support, control price and current price. Okay, then you will know the possibility of it moving lower is much lower compared to for it to move higher. There's more space, more room for the stock to move higher. So that is what basically we want. Okay, so if there is the possibility of 2-to-1 minimum risk reward ratio, then you can go and sell an options on it. But again, at any time, the rule of thumb is if the price is at control price or higher than that, just ignore those stocks. Okay, so there you have a particular method of calculating the risk reward ratio for an option sellers. This is a method created by me. This is how I've been using it. Okay, although sometimes I just don't go throughout calculating all this one by one. I just I calculate it in my mind. I see the support, I see the current price, and I see the distance to the control price. As long as the distance to control price is much bigger than to the support, I'm fine with it, at least 2 times more. Okay, so here you have seen the whole risk reward ratio topic. Remember, it's extremely important. Many traders actually avoid this, they don't calculate it, but to me this is one of the biggest key element for you to decide it's a go or a no go, it's a buy or no buy, should I sell an option or should I not sell an options. Okay, no matter what, even if the price at the buy region or whatsoever, this risk reward ratio finally decides if it's worth it or not. Okay, so there you have covered all these topics of risk reward ratio. Now I'm going to move on to the third screening element that we have in our MVP screener. We have looked at the three bullish three black crows, and then we have looked at the volume anomaly screener. Those are the things that have given us all kind of great returns so far. So now we're going to introduce to you all the third element, which still belongs to the value anomaly strategy. So what does buyers at support basically does? So it screens for stocks with MVP entry signal pattern at possible strong support level. So this basically screens stocks which has shown the MVP entry signal, okay, either the hammer doji kind of pattern or the pivot momentum or double white soldier kind of stuff, and at a possible strong support level. Remember, this is just possible, so it tries to screen the possible stocks that are at the strong support level with the MVP entry signal. We still have to manually go back and double confirm the setups, okay? Remember, software only helps to a certain extent, expedites your whole screening process. Instead of about 500 stocks, it gives you about 5 to 10 stocks, okay? So only rejection pattern with high volume is accepted. Okay, as usual, MVP method volume is given a whole lot of importance. So these stocks not only screen stocks with MVP entry signal at the strong support level, but it only shows stocks which also has high volume. The rejection pattern must come with high volume. And it also discards stocks that had a big gap down the day before MVP entry signal was identified. For an example, this could be the support level, and you could see a particular hammer over here. But if the previous price was at here, okay, the previous price here, and you had a big gap down, and you had a hammer here at support, this will be eliminated as well. This will not be included as part of the bias at support, because this, when there's a huge gap down, there's a big selling pressure. Just one hammer or double white soldier is not acceptable for us to trade on that stocks yet. We need certain amount of price movement before we actually ever consider to trade such stocks. That is why I don't like to trade stocks that just recently had a big gap down. It's extremely risky. Okay? Never catch a falling knife. Keep that in your mind. So, discard stocks that had a big gap down the day before MVP entry signal was identified, was discarded, and this is also highly suitable for short-term trading. Okay, you can also use the daily screener to look out for stocks that fulfill this bias at support criteria in the daily chart, and you can actually sell options or buy stocks and look for a profit within a week or 2 weeks kind of a period. Okay, it's highly suitable for option sellers for a 1 week expiry as well. Okay, if you use the daily screener for bias at support. So this is an example of the screener that took place for last week, throughout the last week, based on a weekly chart. Based on a weekly chart throughout last week, what was the stocks that fulfilled the bias at support that we can look at for this particular week? Okay, for this particular week in June week 3. So these are some of this that I've actually posted in the forum that we have actually taken a trade actually for this week. So one of that is Philip Morris. Okay, I've actually shown about the rider as well. You have X-ray, you have MDP, this kind of stocks. So these are all those stocks that fulfills these bias at support criteria. And if I have to show you, for an example, if I show you the PM Philip Morris chart, it will take how many days for us to go through all the 300 stocks. Here the screener has quickly given us a stock with a hammer setup with a good volume at good support level. Now all we have to do is to wait for a confirmation signal in order to trade it. This is how it simplifies the whole process of finding a trade. PM is a very nice trade that was suggested by the screener. At buy region, high volume, hammer, that's everything that we need for this particular static value channel strategy for Philip Morris. Another one is rider. Again, we had a really nice setup. We had a hammer, okay, with high volume, and we also had a confirmation. And this particular setup took place at the buy region, and it's actually a double defending because earlier it had a doji, came up, and now it came back down. Then we have another hammer. Super nice, super nice. So these are all the setups that are given by the bias at support. Again, look at stocks, get into the screener, check those stocks, open up your chart, double confirm, and then we trade it. Okay, so here we have bias at support with all these elements of how we actually screen it. Okay, so I'm further introducing further setups to this bias at support. I'm further improving it. One of the improvement that I have done is, of course, those taking down those stocks we just had a big gap down. I discarded. I'm further introducing more stuff into make it to improve the accuracy level. Okay, so here you have all those nice setups. You can even look at MDP X-ray. They are all the stocks with extremely nice setups on the weekly charts. Okay, so that's about it.